Hey everyone, welcome back to Corporate Decoder, the place where we peel back the layers of corporate finance and see what is really going on under the hood. Today we're diving into the Columbia Funds series, Trust I, a Behemoth in the Investment World. And let me tell you, this filing is packed with numbers that tell a serious story. So what is the big picture here? Well, we're looking at multi-manager total return bond strategies, funds specifically their institutional class shares as of the 31st of August 2025. Think of this as a snapshot of where a massive bond fund stands financially. It's like looking at the wallet and health report of one of the biggest players in the bond market. Before we jump into the nitty-gritty, stick around after the hook to find out how you can join our growing Discord community for more exclusive corporate insights. Let's get straight to the heart of it, the financials. For the year ending the 31st of August 2025, this fund is sitting on a mountain of assets worth over $15 billion. That is a serious chunk of change, but it's not just about how much they have, it's about how it's performing. Their net investment income for the year was a cool $588 million. Chump change for some maybe, but for a bond fund that is a solid performance. This income comes from dividends and a hefty chunk from interest. Now, for the less sunny side of things, they had a net realized loss of almost $200 million. That is not ideal, and it comes from investments particularly with unaffiliated issuers. On the flip side, they saw a net change of over $45 million in unrealized appreciation. So some investments grew in value on paper even though they weren't sold. That helps cushion the blow from those realized losses a bit. Overall, the fund holds investments in securities valued at nearly $15 billion. That is a massive portfolio, meaning they are influencing a lot of the bond market. Their cost for all these investments was even higher at over $15 billion. So they are currently sitting on a slight unrealized depreciation across their entire portfolio. Now let's talk about the cost of running this fund. The total gross expenses were just under 0.5% of their average net assets. That might sound small, but for a $15 billion fund, that is still over $70 million in expenses. We see interest on collateral amounting to about $125,000. That is like a small loan fee. When we look at the investment performance for the institutional class shares for the year 2025, we see a total return of 3.36%. This means that for every $100 invested, the fund grew by about $3.36. Comparing that to the Bloomberg US Aggregate Bond Index, which grew by 3.14%, the fund slightly outperformed its benchmark. That is a good sign. However, looking back 5 years, the fund actually lost 0.33%, while the benchmark lost even more at 0.68%. So they had some tough years, but managed to outperform their benchmark in that particular tough stretch. This shows that while they might not always hit home runs, they often do better than the average. One of the most interesting parts of this report for me is the ratios to average net assets section. This tells us how much it costs to manage this massive fund. The total net expenses hovers around 0.49%. This means for every $100 you have invested, you pay about 49 cents in fees. That is actually quite low for a fund of this size and complexity. It suggests good cost management by the investment manager. Now let's look at the risks. Their risk exposure category breakdown shows a significant exposure to interest rate risk at 23.5%. This means the value of their holdings can swing quite a bit if interest rates change. They also have 10.2% exposure to short credit risk and 0.6% to long credit risks. This tells us they are actively managing their exposure to the possibility of companies defaulting on their debts. One of the biggest categories in their portfolio under asset-backed securities, non-agency, is 12.6% of their total net assets. This means they have over $1.7 billion invested in these types of assets. These are bonds backed by pools of assets like auto loans or credit card debt. The fact that it is non-agency means these bonds aren't backed by government entities like Fannie Mae or Freddie Mac, which can introduce more risk but potentially higher returns. Looking closer at their investments, we see some interesting names like First Key Homes Trust, with a coupon rate of 1.339% and a value of over $5 million. This tells us they're investing in a variety of different types of asset-backed securities, some with lower rates possibly considered safer, and others with higher coupon rates indicating more risk. Another big chunk, and again it is the non-agency part that catches my eye, is commercial mortgage-backed securities at 7.2% of their portfolio. This is over $970 million focused on commercial real estate, investing in non-agency commercial mortgage. Backed securities can be complex and carry higher risks than agency-backed securities. Now for the derivatives, their average notional amounts gives us a glimpse into their risk management. They have a massive notional amount of over $3 billion for futures contracts, long and nearly 233 million short. This indicates active trading strategies likely to fine-tune returns or manage risk. They're also involved in swap contracts with a substantial notional amount, suggesting they're actively managing interest rate exposure. So what is the verdict? This fund is massive and it is actively managed. They've got a lot of exposure to different types of debt, from government bonds to complex asset and mortgage, backed securities to credit default swaps and futures. Their management fees are impressively low at around 0.49%, which shows good cost efficiency. The fund's performance in the latest year edged out its benchmark, showing they know what they're doing in the current market. However, there are risks mainly tied to interest rates and credit. The huge notional amounts in derivatives like futures and swaps show a sophisticated approach, but also a greater potential for volatility. The large investment in non-agency asset and mortgage. Backed securities could offer higher returns, but also introduces more risk. Overall, this fund seems to be navigating a complex market, skillfully staying just ahead of its benchmark. They're not afraid to use advanced financial tools to manage risk and seek returns. It appears to be a well-run fund, but investors should always remember that bond markets, especially with these kinds of exotic securities, always carry risks. Alright, that is our deep dive into the Columbia Fund series. Trust iFiling, what are your thoughts on this financial powerhouse? Let me know in the comments below. If you found this breakdown helpful, then please hit that like button and subscribe for more in-depth corporate analysis. And don't forget to join our awesome Discord community, linked in the description for more exclusive content and discussions. Thanks for watching, and we'll see you in the next one.